Hey, everybody. Thanks for joining us, clients. We're excited about kicking off 2025 with a bang. Didn't take long for things to start happening. So we're here to talk about the PSX acquisition of Epic and our thoughts around it. So a little housekeeping before we get started. The written version of DLS will be coming out soon. A few big themes this year: commodity ties, everything is tied together, which goes along with this webinar. Also, one of our bigger themes in DLS, the written part, is integrateds trying to figure out how to get more integrated. So look for that, and again, goes along with this theme. And then we're doing a Houston trip on January 27th through the 29th. We'll be out there with an entire slew of analysts and our team. So if you're interested, contact information is below. So I'd like to welcome in our NGL team, Rob Wilson and Julian Renton. Hey guys, thanks for joining us.
Yeah, Chris, good to be here.
Thank you, Chris.
Yeah, so Julian's one of our newer analysts, and Rob, probably most of you already know, and he's been with us for a long time. So Rob, I'm going to turn it over to you. Why don't you tell us what we're going to be talking about today?
Great, thanks, Chris. So really 5 takeaways here we're going to go through. One is, yes, Phillips 66 acquired Epic. I do think, we think there's a bigger game being played here, and that's the bet on NGLs, petrochemical growth, light plastics. So it's getting integrated into the growth behind that whole complex. We will talk about the deal and why it makes sense for PSX. We believe it's a good deal strategically, cements them as one of the large integrated players alongside the big 3 incumbents, Enterprise Products, Energy Transfer, and Targa. It does pose a challenge. They are now long NGL pipeline capacity and short on NGL production out of plants they own. There is a solution to this. Of course, you can aggressively contract to maintain and win more barrels on your systems. There's also several, I'll say, potential targets Phillips 66 could go after on the G&P side to secure more NGL production, kind of similar to what EPD, ET, and Targa have done over the last couple of years. And then finally, we'll go through one of them in a little bit more detail, Salt Creek, their G&P system in the Delaware, and explain why an asset like that could make sense as one of the potentials.
Thanks, Rob. Hey, real quick, clients, we're going through Salt Creek today just because we have a 2-hour webinar and nobody wants to listen to us talk for 2 hours. But we do have all the other players in our Energy Data Studio, which you have access to. So if you need to know how to access those after we go through this webinar in Salt Creek, please reach out to us. We're happy to go through them anytime. So Rob, back to you.
Thanks, Chris. All right, well, what's the hubbub about NGLs? I think there's a couple things. One is the value chain is lucrative. We've talked about that. If you look at crude or you look at gas, the value chain for midstream isn't quite as integrated. So it makes sense that midstream players would want to integrate. For NGLs, they could get the barrel all the way, or the molecule all the way from wellhead to the dock. There's another reason too, though. Natural gas demand growth is strong, and these are bullets or themes that the EIA, IEA, and OPEC have all addressed over time. There's a massive LNG build out. Our natural gas team covers that in great detail. On the NGL side, there's been a focus or a shift to the lighter end of the barrel, and what this looks like is ethane supply being used in ethylene production, propane supply being used in propylene production. And we see this in the US where there's capital being spent on export docks, EPDs, Neches River, Energy Transfer's Netherlands expansion, Enterprise's hydrocarbons terminal, which exports LPG, and Targa's Galena Park. On the demand side, there's several facilities that will either ramp up demand for ethane and NGLs or LPGs, and I've just listed a few here. There's a significant amount of capital being spent on ethylene and propylene or PDH crackers that require ethane and propane supply. Again, the lighter end of the barrel, that's where the growth is. That's where companies want to be integrated and really cement their position. And then there's still activity on the crude oil side. It's just we've seen global demand taper for crude oil demand with respect to things like automotive transportation. So this again, taken from the IEA, shows LPG and ethane growth from into 24 and then into 25 remaining robust. And there's a quote there from a recent report. I won't read it, but it is a secular trend that we're seeing that's corroborated by the capital being spent in the space. What has received a lot of fanfare in the Permian is on the upstream side. So there's been a lot of consolidation in the Permian. And if you look back 2-3 years, about 50% of production was owned really by public producers relative to private producers. We've seen massive consolidation in the space. Notably, Exxon's acquisition of Pioneer was the biggest one. And so now we have about 75% of production owned by public companies. What does this mean? They have a bigger inventory of production. Growth has moderated. It's not slow, but it's certainly moderated. I'm not going to spend a lot of time here because this is a story that's been played out or covered pretty darn well.
Well, hey, Rob,
Yeah.
I got to jump in here. I need to do a shameless plug. I know you put together that slide or thought of it, and that slide was actually the Wall Street Journal wrote a piece on Permian producer consolidation and what that means moving forward, and you were quoted in it. So for all of you out there that haven't read the Wall Street Journal, I believe it was, 3 weeks ago now?
Yeah, 2 weeks ago.
Yeah, this slide was the precipice of the story written on the front page of section B, I believe. So check it out. Look up Rob Wilson, Wall Street Journal. He's in there.
Thanks, Chris, for that. What we are talking about today is the consolidation we've seen on the midstream side. So the blue line shows the amount of, or the percent of rich gas owned by the tickers at the bottom of the legend. So EPD, ET, Targa, ONEOK, etc. And a greater share of rich gas supply, about 75%, is now owned by those players along the bottom. What this means is more NGLs are now controlled by fewer players, and that's what we're talking about here. Targa, Enterprise, and Energy Transfer have certainly already made significant acquisitions to shore up NGL production to feed their downstream assets, right? So NGL pipe, storage, fractionation, export facilities all play into linking growing supply from the Permian to growing demand along the Gulf Coast. Phillips 66 did acquire DCP, didn't really do much for integration because DCP was already integrated with Sandhills, but it did put those assets under common ownership, which has led us to where we are today. And today, moving forward, or I'll say in the last year, Phillips 66 acquired Pinnacle, that's G&P, or NGL production. They've essentially acquired to feed their downstream assets. Kinetic acquired Durango, so that was a similar to what we've seen from the large integrateds. Energy Transfer made a big splash with West Texas Gas to really firm up their midstream portfolio. And then ONEOK, with the acquisition of InLink, certainly gave them NGL production that they did not have prior to that. So what then did Phillips 66 acquire Epic for? Sandhills is nearly full. They get NGLs from both the Permian and the Eagle Ford, but let's talk about the deal itself.
Yeah, thank you, Rob. We're gonna run through the deal real quick. On the left, you can see a map of current PSX assets showing Line Easy and Sandhills and the Epic Y-grade pipeline. Not showing the map is also 2 fractionators near Corpus Christi. The deal is a $2.2 billion acquisition by PSX to buy the crown jewel, the Epic Y-grade pipeline, 700 miles, having a capacity of 175,000 barrels a day, and it's currently being expanded to 350,000 barrels a day. Like I said earlier, 2 fractionators as well near Corpus Christi, current capacity of 170,000 barrels a day. They are expandable to 280,000 barrels a day, although PSX said that they're not looking into that until 2027. And
Hey,
third,
Julian,
yep,
real quick, and sorry to interrupt you before you get to the star, but all this data, you can find it in Energy Data Studio, correct? I mean, this map is out of Energy Data Studio and all the data you're going through is out of there, correct?
yeah, that's right, Chris. Rob has the picture pulled up right now, Energy Data Studio. We pulled it right off. If you have any questions about how we got to that, feel free to reach out to us and we can show you.
Yep, under the NGL vertical, under market model, you'll see NGL hub model. Just go to the map. You can layer on the plants and pipes you want, but as you can see, Line Easy, Sand Hills, and Epic visually shows the integration that Julian is talking through right now.
Yeah, thanks, guys. All right, Julian, sorry, bring us home.
No worries. The third part of the deal, and very importantly, is a purity product distribution system that can move bidirectionally between Corpus Christi, Sweeney, and Mont Belvieu. It currently has a capacity of 450,000 barrels a day. And we're going to talk a little more about that in the next slide. So there's been a couple of questions around why Phillips in particular. There's been some other names being thrown around. And in short, it just comes down to asset integration. The Epic pipeline will connect directly into Sweeney Complex, Phillips has said. And the fact that they have the downstream infrastructure to take full advantage of Epic and its fractionators. As you can see on that map on the left, those are the fractionators I was speaking about earlier, down near Corpus Christi. And I think really coming back to point 3, the thing that makes this deal such a star for Epic, for Phillips, is the bidirectional highway that they have between Corpus Christi, Sweeney, and Mont Belvieu. It's going to allow them to optimize their synergies throughout their whole value chain, optimizing their exports, their fractionation, their refining, with complete control of the molecule up and down the Gulf Coast.
Yeah, that's a good point, Julian. The Epic's connectivity to Sand Hills gives it access to both Sweeney and the Freeport export facility. Sweeney's already interconnected with Mont Belvieu, so the bullet there in the lower left hand is really the key. The transaction gives market optionality, and Mont Belvieu is the most liquid, as opposed to a pipeline that's kind of stranded and let's be honest, the second tier hub. This now gives them access to all 3 hubs along the Gulf Coast, and certainly significant value in that. Anything else here, Julie, to point out?
No, just want to point out the 2 quotes at the bottom. Epic fits us like a glove, said by Phillips CEO, and just really highlights just the asset integration. That was just a perfect deal for Phillips, where I don't believe any other company could have made full use of Epic like Phillips is going to be able to.
Okay, great. Thanks, Julian. So we talked through the first 2 bullets. Like I said, we believe the transaction is favorable for Phillips 66. It does pose a challenge, long NGL pipeline, short NGLs. So what are we talking about? Well, there's a lot of NGL capacity coming online right now. You have Daytona, which came online 3Q24, and by the way, reason why we think Targa will have a record earnings quarter in 4Q is because of a full run rate of Daytona. And we've seen NGL production increase in the New Mexico part of the basin because of that. That's not the only story, though. You've got Bahia from Enterprise, Bengal from MPLX, the Epic expansion that we've talked about, and then West Texas NGL also has an expansion. So yes, NGL production is growing, and it's growing fast out of Pad 3, namely from the Midland and even more so the Delaware. Because of that, utilization rates are going down, which will likely put pressure on TNF spot barrels into 25. For PSX, what we're talking about here is that red circle 22% number. The estimated 4Q NGL production includes the Permian and the Eagle Ford. The total capacity or the denominator includes the expansion. So it's not the utilization we see now, it's the utilization we'll see when the expansions come online. For PSX, that 22% number, does put them at risk for utilization. Like I said, they could aggressively contract for the NGL barrel. That would put pressure on T&F rates. Another solution to that problem really is acquiring G&P systems like ET, PD, and Target have done in the past that would certainly help shore up NGL production that they don't own. And you might say, well, you just showed me all of the G&P acquisitions that have been made. Is there anything even left in the Permian? And there is. So if you look at total NGL production, 4.2 million barrels a day, there's about 1.2 that is owned by companies other than large integrated. So there is also expansion projects, like Phillips 66 is expanding the Pinnacle system it acquired in the Midland. So there's some organic growth. It's not that the basin's not growing, but if you want to increase your ownership of NGL production quickly, well, an acquisition or two would be the way to do it. Anything that you're Chris?
Yeah, just real quick to jump in, because on your screen we had a Teams message pop up from Ajay, but Ajay talks a lot, and we've been around talking to clients about utilization rates on NGL pipelines. You have to look at them a little bit differently than on other pipelines. So I don't want our clients out there thinking, oh man, these are really low utilization rates. So it's a little bit different, right? Ajay, I believe, was saying, hey, at 50%, they're still making some money. Now that could change as T&F rates change, but it's a little bit different. So if you want to know more about, hey, how this may affect company earnings and stuff like that, please reach out. Jay's always happy to, and that capital intelligence team, to talk about it.
Yeah, good point. Thanks, Chris. So let's talk about some of the systems that are out there, because certainly it's not wrong to say a lot has it now falls under integrated ownership. But here are a few. So Salt Creek, Matador, the Matador San Mateo, Vaquero, the Howard Devon State Line system, Brazos and Canes are 6 systems. All of these are in the Delaware, which is where we've seen a lot of the gas growth, except for Brazos, which has both the Delaware and Midland system, and Canes, which is in the Midland system. There are also, I'm not intentionally ignoring, there are a couple publicly traded companies that are out there that could also potentially be targets, Western Midstream and Kinetic, that would be similar to what we saw with the One Oak EnLink deal. Those transactions obviously a little bit more complicated, especially with Western Midstream, where Occidental Petroleum owns the GP of WES. But we really wanted to focus on, for today, producer-owned or private midstream systems. What we have in row 1, and this is some of the criteria we considered when we were looking at these systems, is the NGL outlets. So the data we have on these systems is we really think about, and Chris said it earlier, we think about supply from wellhead to G&P system to NGL pipe to frac, storage, and export. Valuable component of that value chain is understanding which producers go to which midstream system and which midstream systems are connected or have optionality to various pipes. If you look at a system like Canes, they're already fully integrated with Phillips 66. There's other systems. And so, when you're thinking about a transaction, if you were to go for some, a company like, or an asset system like Canes, that would be more of a defensive play, right, Chris? Like you'd merely be shoring up the NGL production you already get. Whereas if you focus on, a system like Salt Creek or Matador San Mateo, or the State Line system for Howard and Devon, there's the opportunity when contracts roll to bring some of that NGL or all of that NGL production onto your own system. So there's a little bit of nuance there, but you can play it either defensively or offensively as far as capturing production you don't currently get on Epic or Santos.
Yeah, Rob, you make a good point, and I think I want all clients on here to, if you want to see from wellhead all the way through to demand, which is how we need to be looking at the market right now. We believe this is what we're doing, right? So you have to understand the full value chain and how it affects every company, and then all the commodities coming out of the ground. And yes, we're going to go through one company here, Rob, or one GMP target to look at, but all of these are probably on the table as targets at some point. Who knows if it's 2025? I'm not going to speculate on that, but as companies, these larger companies look to capture the full value chain.
Yeah, thanks, Chris. And one thing you asked me to hit on really, Chris, was that connectivity, and we didn't really hit on it yet, but producers feeding the systems, you can see at the last line of the table. One thing we are going to come out with in the near future, probably within the week, is our outlook on the Permian. A lot of producers have already signaled to growth from 24 to 25. Like Exxon 7.5%, Vital Energy 8.5%, Chevron, we estimate about 6% oil equivalent growth year over year. So understanding the producers behind the systems will definitely give you a view on how much these systems themselves will grow year over year as well. So look for that in the next week or two as we shore up our Permian outlook from 24 to 25.
Well, Rob, thanks for that. Let's look at a system, man.
Yeah, let's do it. So let's tour the Salt Creek property. This is their system. It does help to understand the history behind the systems when you're looking at, what we talked about earlier. Where are the NGL barrels going today? Where might they go in the future? So Salt Creek Midstream was established in 2017, a JV between ARM Energy Holdings and Ares Management. The Pecos 200 a day system became operational in April 18, Pecos 2 in mid 19. There is some, guesswork or estimation here without seeing the actual contracts themselves. Usually these run at 10 to 15 year tenors, which implies NGL contract rolls between 20 and 33. We don't know that, we're speculating, but usually looking at when the plants come online is, it's not inconceivable that these are when the contracts roll. It's likely. And then when you look at current asset integration, we talked about this. The EPIC NGL pipeline is already connected, as indicated by the black squares on the map, to EPIC and Chinook. From a residue perspective, they hook into Kinder Morgan's El Paso and One Oak's Roadrunner natural gas pipeline outlets. So, the ability to integrate with the existing system is important to know. When we're talking about the producers behind the systems, we do look at this stuff. It's how we basically balance supply from wellhead, including rig activity and forward growth. When we look at Petro Hunt, they're running a 3-rig program. However, the current rigs are likely on Brazos, CQP, and Vaquero or Wes. So none of them appear to be on the Salt Creek Midstream system now. Civitas, also a big producer behind the system, is running a 3-rig program, but all those rigs are running in the Midland, Glasscock, and Martin counties. What is not listed here, we do see Franklin Resources and Vital Energy potentially have 1 or 2 rigs running on the system, enough to keep the supply outlook flat to moderately growing. And showing some of the historical plant throughput with respect to capacity, that's what the chart up top is showing you. There's a couple things to consider here. One, if we see more rig activity in the system, there's an opportunity to expand the Salt Creek system. If the rigs remain off the system, then if you're Phillips 66, you could potentially be acquiring some latent capacity to move your supply over to the Phillips 60 or the Salt Creek Midstream system. And I'll show you in a minute on a map. The systems they would not be difficult to integrate. The upside is, it's already hooked into EPIC. Salt Creek is, with the ability to divert more of the NGL production to EPIC or Sand Hills from Chinook when those contracts roll. Of note, it's a high pressure gas header system that could easily connect to the DCP Delaware system. So I'll show you what that looks like. Again, I'm going to hop into our Energy Data Studio. The challenge in talking through this in a short amount of time is we cannot cover all 6 systems, but as a client, you can pretty easily go into our Energy Data Studio and use the GNP. It's right here under Gathering and Processing, the GNP comparison tool, and you can layer on any 2 systems to show DCP Delaware system in green and the Salt Creek system here in blue highlighted, as well as data behind those systems like IP rates, decline curves, rigs on the system. So let's say you're not interested in doing a deep dive into Salt Creek, but one of the other systems we talked about, you can very easily navigate on EDS and do your own exploratory digging as well.
Hey, thanks, Rob. I do want to point out too, the upper left there with the producer volumes behind the system. We have those on all the systems too. And what's cool about that is you can actually download the volumes we have. And then when we start to get producer guidance, you are able to run your own scenarios with those. And you can obviously call us. So I do want to encourage all clients. We know sometimes it's hard to know all the resources you have access to. So please reach out to us if you have questions on how to get there.
Thanks, Chris. So key takeaways, again, our view on the PSX or Phillips 66 acquisition of Epic NGL assets is favorable. It does cement their position as a large integrated NGL player. Again, linking growing supply to growing demand, not just domestic, but the export markets as well through Phillips 66 Freeport terminal. The transaction does leave PSX long pipe and short NGL plant production, which is why we believe Phillips 66 will be an active buyer of Permian Basin GNP systems. Gun to my head, I'd say Delaware over Midland, but that's probably just because that's where we're seeing a lot of NGL growth, and that's where most of the non-integrated GNP systems live. So again, thanks for joining us. As Chris pointed out, we'll be in Houston January 27th through 29th. Please reach out to us if you haven't already regarding our annual outlook and dirty little secrets. Chris, anything you want to wrap up with before we say goodbye for now?
No, hey, just real quick, clients, we appreciate you. Thanks. We look forward to you reaching out to us. All the links to things that we did are in that previous slide. So product links, the daily note, things we've written on that. And then if you haven't already, next slide, Rob, hey, this is all material you get access to. So please sign up for it. Comes to your inbox daily or weekly. And again, we'd love to hear from you. Insight@eastdaily.com. We'll get it into the tree and we'll make sure we get your questions answered. So that's it. This webinar was a little longer than we anticipated, but a fun topic to kick off 25, Rob.
Yeah, I agree completely, Chris. I think it's a fun 25 ahead of us. Energy markets are interesting right now. There's a lot of shifting from a strategic perspective. So yeah, I'm excited for what's ahead.
Yeah, awesome. And if you do talk to Julian, everybody, this is his first webinar with us, so congratulate him. He's awesome and knows his stuff on the NGL, so please reach out to him. Thanks, Julian.
Yep, thank you, Chris. It was great being on.
Thank you, guys. Thanks for everyone for joining us today. Talk soon. Bye.
Talk soon.